In recent weeks, we've seen a rally in the stock market and the bond market on the belief that we've finally seen the end of the Fed raising interest rates. We had some weak economic data projections of the Atlanta Fed where they were projecting roughly 2.3% growth. Now it's at 1.2% for the fourth quarter, as well as some softening job numbers. And the Federal Reserve tends to take the job numbers very seriously. So with weakening economic numbers, the market is building in the belief now that the Fed is done raising rates. And I think as a result, the bond market has rallied, driving interest rates down, and the stock market has also rallied on the belief that rates aren't going to go any higher. So this has helped asset prices in both the stock and bond market over the last couple of weeks. Whether it can continue remains to be seen, because ultimately a weaker economy is going to weaken earnings and drive stock prices down. So we'll have to watch here carefully. But I think this is more a relief rally than anything at this point. In 2024, I think we're probably looking at a weak economy, that the 2 years of rising interest rates have finally put a real damper on growth in the economy. And these higher interest rates are going to cause problems. For example, the mortgage market in the US and the commercial real estate and office space sectors are going to be hit very, very hard as mortgages come due and are going to have to be renewed at much, much higher rates. So the commercial real estate sector specifically in the US could be a ticking time bomb, where the fallout from that sector could spill into the entire economy. So I think it's quite possible in 2024, we're looking at interest rate cuts by the Fed, a tough stock market, because I think earnings are going to be pulled down by the higher interest rates over the past couple of years, and a problem in the real estate market going forward. You build in two ongoing wars where money's being diverted into, armaments and the military. I think it's going to be a tough year, 2024, and investors have to invest accordingly. Going forward, one of the problems is the fiscal budget deficit of the U.S. We've seen over this year that the budget deficit got up to about 8% of GDP. The U.S. GDP is around $27 trillion, and with them running a $1.7, $1.8 trillion deficit, expected to go up to $2 trillion next year, that's a huge deficit that we've never seen other than during wartime or during recessions. So the question is, with all of the problems globally, how are they going to fund a $2 trillion deficit? With, historically we had Japan and China large buyers of U.S. treasuries. That's no longer the case. With the U.S. Freezing or taking Russia off the SWIFT system, and the U.S. effectively holding $300 billion of U.S. reserves that belong to the Russians, a lot of countries and corporations are loath to invest in U.S. debt for the very fear that they may be frozen in future sanctions or tariffs. So who's going to buy bonds worth $2 trillion to fund the deficit? And the solution isn't readily available. I've asked many people, many economists, how's this going to happen? And there's no surety as to how they're going to do this. One is capital controls, where potentially they force possible banks, insurance companies, pension plans to buy this debt, or they have to price this debt at lower price and higher interest rates to attract buyers. So it's a really delicate issue that nobody knows how is going to play out. But $2 trillion is huge, and there aren't a lot of willing buyers necessarily going to step up and absorb an additional $2 trillion of U.S. debt in 2024. The permanent portfolio is designed to hedge against all economic scenarios. And given how tough the markets are now with all of the uncertainty, I'm quite confident that our permanent portfolio will do very, very well. We've got a very good yield on the fixed income portion, roughly 5.5%, with greater potential given our preferred shareholdings that can reset at the much higher bond yields that we're seeing now. We've also got a 20% weighting in gold that will hedge the potential inflation that war creates as well as 5% silver. And we only really have a 20% equity weighting. So if markets and the economy are very weak, we're not going to be hurt too badly because of the lower equity weighting compared to traditional, 60-40 equity bond portfolios. So I'm quite confident that the permanent portfolio is going to do a wonderful job in 2024 in generating returns, but also in preserving capital in a very, very difficult marketplace.